Nearly 100 community bank leaders are warning that crypto dollars are quietly pulling deposits out of small-town banks, with the public possibly on the tap if one breaks. That risk hit the hearing. Watch, then stay for the fact check.
Thank you, Mr. Chairman. I thank the ranking member as well. And I welcome you to the committee, Mr. Chairman, but I would also say to you that I will pray for you. And I'll pray for you because many of the questions that have been predicated today hinge upon a belief that you will sanction the president's desires. It is thought among the general public that you're in the position you're in because the president could not have the influence that he wanted to have with the prior chair, and he believes he can have it with you. So I hope that you will stand firm and honor your commitments that you're making, though some of them are not firm commitments as I understood your language. You indicated that you're interested in war. I appreciate this, but I believe you should also be interested in speculative bubbles. My assumption is that you are. Are you interested in bubbles, speculative bubbles, Mr. Chairman?
We've got a wide lens. We spend a lot of time thinking about what's happening.
I'm going to take that as a yes. Now, given that you're interested in speculative bubbles, let's just talk about a bubble that occurred. President Trump's meme coin, $Trump, profited an average of $1.74 million per day over his first year. $1.74 million per day. This amounted to approximately $636 million in total royalties and licensing fees generated at its launch. While this was happening, during that same period of time, nearly 1 million investors lost a combined $3.8 billion. This is because that meme coin lost value, dropped precipitously in value. It was a bubble, by the way. It is nothing. Anybody who's listening to me, if you've invested in a meme coin, you've invested in nothing. Zero. In a righteous world, it would be illegal. But given the Secretary of the Treasury that we have currently, it is not. And that's very unfortunate. SEC, the Secretary of the SEC, it is not. I think that we should concern ourselves with these speculative bubbles. And whether you like it or not, you have to concern yourself with it because when you lower interest rates, you lower the rates such that there's more capital available for people to use for speculative reasons. So you have to be concerned about it whether you want to or not, because you don't want to see a speculative bubble. Can I have your assurance that you will be concerned about these speculative bubbles, Mr. Chairman?
So, Congressman, we want a resilient, strong, safe financial system, and we are looking at financial markets and we're looking at the real economy to make sure we deliver on what we can. Some of these other subjects are really more in your purview and responsibility than
they're in my purview. Excuse me for interrupting, but I have to. They're in my purview, but only because I choose to have them in my purview and I make an issue of them. I have to vote on them. But they're in your purview too because you decide whether the rates go up or down. And if you lower them, then people can engage in these speculative bubbles, such as the Trump meme coin, and they can lose a lot of money. Losing billions of dollars while the president makes millions on a daily basis. This is the epitome of ridiculosity. At some point, we all have to take a stand, Mr. Chairman. This is going to be your opportunity. You're going to have to take a stand at some point because this president is interested in making money. He puts money ahead of the people of this country. The people of the United States of America are secondary when it comes to the president. They may even be tertiary or quaternary, but they're not first. And at some point, you're going to have to make a tough decision as it relates to this president. Look, I'm not going to prejudge you. I'm going to assume that given your statements and the latitude that the Supreme Court has given you, that you'll make the right decision. But you're going to have to be concerned about a speculative bubble, especially as it relates to crypto. This is something that we'll all have to address. I thank you very much.
And so the problem, of course, is that right now we have in the White House an occupant who sees his every power as a means of rewarding his friends and punishing his enemies, domestic and foreign. We saw that an example in the Argentine bailout, where he implemented swap lines using the Treasury's Exchange Stabilization Fund. I think he pretty much maxed it out. But to reward one of his MAGA allies internationally with a $20 billion loan at well below market rates, or probably they couldn't get a loan from anyone at that point. And so the question that I have, that when you and the FOMC are operating those lines, particularly in times of crisis, do you see yourself as an agent of the president or as an independent actor?
Thank you, Congressman. I appreciate the question. The swap lines that we put in place in the 2008 financial crisis, like you, I think, played a remarkable benefit in trying to mitigate the risks for the U.S. economy. And it reinforced that the dollar is the dominant currency in the world. Now, my judgment as central bank chief is to let the dollar policy be discussed by the Treasury Secretary and leave that to him. But historically speaking, I think the swap lines played a major role. The dollar liquidity swap lines that the Fed has put in place are about the conduct of monetary policy. So those are independent, but I just want to distinguish one thing. The Treasury has separate authorities and can use the Exchange Stabilization Fund for swap lines that are unrelated to our powers and responsibilities.
Right. Yeah, but the Fed's the big dog in swap lines. I mean, the ESF is, I think it's somewhere a little bit north of 20 billion, I think, is the most that they could deploy, which they did, much, I have to say, not to the benefit of U.S. farmers that I represent, but anyway, he decided to bail out his friend in Argentina. But that was the Treasury, and that was different. So the question is, what happens if there is a crisis and you get a call from the president and says, I got this friend that I want you to bail out or punish by politically allocating those swap lines? Is there an independence there that we have to protect as well?
So the independence in the conduct of monetary policy and everything that comes along with it is independent. But just to go back to the 2008 financial crisis, when all that happened, as you'll recall, the Treasury Secretary and the Fed Chairman, they often had to work in tandem. It's hard to distinguish in crisis times, separate from more benign times, exactly where those roles and responsibilities are. And when we put in those swap lines, when I was a governor at the Federal Reserve, I remember frequent discussions between the Treasury and the Federal Reserve. We have our independent authority, but I don't want to leave you with the impression that in 2008 or 2009 we did that without a discussion with the Treasury.
Okay, well, I just, be very careful of that because you are going to be coming under extreme pressure. Now, let's say I applaud all of your focus on data, which we talked about when we talked, and in particular your need for better real-time data. The question of whether we could have picked up the inflation earlier with more leading and real-time indicators, I think is a very valid point, and I applaud you for having your committees investigate that. But does this interest also go into real-time regulatory information as well, which I think is really going to be crucial in a world where there's 24/7 banking operations? Banks and financial institutions can get in trouble fast. And so are you also going to be looking at the need and benefit for regulatory data on a faster timescale?
Absolutely. I've only been here for 7 weeks. The focus in those first 7 weeks, I must admit, is making sure that monetary policy gets back on track. But many of these lessons learned, like in data, how do we make real-time decisions isn't just as monetary policymakers, it's as supervisors and regulators. The world, as the discussion about AI suggested, the world's moving faster, the world's accelerating, and the Fed has to move with that speed.
Thank you. Yield back.
Thank you.
Jump into this, because in your testimony, you talked about the Federal Reserve's, and I quote, rightful independence in the conduct of monetary policy, which is good. Now, as the Chairman Hill has indicated, I also do some foreign affairs work, and I'm very concerned about what's taking place in the Strait of Hormuz and rising cost of gas, because we know that when those prices go up at the pump, it gives higher transportation and energy cost, and they work their way through the economy, generally making groceries high-end household goods, etc. So it depends upon handling it. So if the administration's handling of the conflict with Iran contributes to another inflationary shock, will you make the decision you believe is in the best interest of the American people and the American economy in that rightful independent stance?
Congressman, that is always our commitment, to make the best decision we can, consistent with the remit and our understanding of the world. And as I said to the chairman at the outset, we'll deliver price stability.
So, and that's, still based upon what we've seen from the president thus far. Now, I just want to be clear, make sure that, because I got to be clear on this, that if the president publicly pressures you to pursue a different course than the one you believe is in the economic data supports, will you follow the president's wishes or follow the data?
My commitment to you is to follow the law and follow the data, follow our very best judgment.
And that's even if he publicly criticizes you for doing it. If you decide this is the way to go, this is what the data shows, and he publicly criticizes you and tells you how disappointed he's in you and all of that, will you still do what the data tells you to do?
I will, Congressman.
You ready for that?
I'm ready to follow the law, and I'm ready for the Fed to deliver on the expansive remit that you gave us. I'll make only one other note. We have a wide lens. We're interested in what's happening in the war. We're interested in what's happening in military conflicts around. We have to take that all in, but then we have to shut the door and make our very best decision. That's what we're going to do in a couple of weeks, and that's what we'll do in the remainder of my tenure.
Thank you. So now I want you to know that I support innovation, but I also believe that the Federal Reserve has a responsibility to protect the integrity of our payment system from political pressure and short-term enthusiasm. And I believe that the administration has made expanding access to fintech and digital asset firms a clear priority of his, but the Federal Reserve has long evaluated access to its payment infrastructure based on safety and soundness, operational resilience, and effective risk management, and the stability of the financial system, not politics, not political priorities. So, can you, and what I should say this also, because what I'm concerned about is that there are firms that's connected to our nation's payment infrastructure that must have robust cybersecurity, fraud prevention, compliance, and operational controls, because failures can undermine public confidence in the financial system and leave consumers exposed to significant harm. So my question is, can you commit that decisions about access to the Federal Reserve's payment rails will remain grounded solely in the Fed's independent assessment of systemic risk, safety, and soundness, and not political direction?
We're going to keep politics out of the Fed. We're going to stay focused on the responsibilities you've given us. And I think you highlight something very important. This new technology revolution, which is hitting the Federal Reserve and the economy, provides huge opportunities. The United States can lead in payments. Our economy can be the strongest in the world and improve its growth rate, but it's not without risks, and we at the Fed are going to strike the right balance between the challenges and the opportunities in payments and more broadly.
Let me just ask this, I got 28 seconds, but what objective standards must any firm satisfy before you conclude that the benefits of innovation outweigh the risk to consumers and the broader financial system?
I like the way you think. A benefit cost test is a good test for economists like us, and if the benefits exceed the cost, then that's the kind of policy, procedure, and objective we want to pursue.
Thank you.
Thank you, Congress.
I want to commend you for declaring your independence. We saw what happens in Argentina, Venezuela, and most notably Turkey when federal central bank independence is eroded. I would say ironically that had your predecessor caved to Trump and lowered interest rates below what economics would call for, we would have much higher inflation today, and that would have been bad for Americans. It would have been absolutely terrible for the Republican Party. So the independent, your agency has saved Donald Trump from himself. And finally, I would say don't rely on this distinction between the Cook and the Slaughter cases. The idea that every congressionally created independent agency isn't independent except yours, you don't want to be relying on that. The distinctions the court makes between your agency and every other agency are rather weak historically. Our capital markets support our business expansion and our economy. Money market funds are an important part of that, buying short-term commercial paper from corporations. Our payment system is designed to meet the needs of honest Americans. That's why we have an anti-money laundering, know your customer rule that makes it a bad system for drug dealers, sanctions evaders, et cetera. There's a rival to these institutions, and that is a cryptocurrency, which literally means hidden money, and is designed to, and then we have in particularly stablecoins, which are just like a money market fund, except you earn zero interest, and everything is hidden. Now, the Federal Reserve established liquidity facilities to support money market funds in the last crisis. Will the Federal Reserve support cryptocurrency or stablecoins if they face a run-on from investors?
So, Congressman, thank you for mentioning many of those issues. We talked about a lot of them in your office, so I appreciate it. I still have the scars from the 2008 financial crisis.
We all
still have
do.
the scars from the extraordinary efforts that my colleagues and I, under Chairman Bernanke's leadership, had to do. That is not something we want to repeat.
Can you
The
assure
reforms
us
that we need are
that
to
you
try
will
to mitigate
not
that.
be bailing out stablecoin and cryptocurrency?
So I don't want to, I can be more broadly than that. We do not want to be in the bailout business, full stop.
But your predecessor did provide a liquidity function for money market funds. If, God forbid, we faced a similar circumstance in the crypto world, would you bail them out?
So I want to be very clear. We're going to do everything we can to mitigate those sorts of extraordinary risks. If and when they were to come in the next 4 years, we want to be in a position we're not bailing out anybody, including crypto.
You're not really answering the question. Obviously, everybody prefers our economy works well. And I'm certainly concerned with giving non-banks direct access to the payment system, and this Kraken filing with the Kansas City Fed is concerning, but I want to move on to Basel III. Your predecessor said that the capital requirements for banks in 2019 were about right. The current reproposal substantially raises those capital requirements. Were capital requirements about right in 2019, or should they be higher than that today?
So the good news is we have a proposed capital rule that's out for comment. I'm quite interested in getting the reports and the comments on that, and I look forward to reviewing those and making a judgment. I would say, as a first principle, strong capital ratios, strong liquidity ratios, strong supervision, and strong market discipline, they're all of a piece to ensure we don't find ourselves in a world where there's unsafe or unsound institutions.
We, of course, want strong limits. On the other hand, if you go overboard, you hurt economic growth and hurt the economy. I hope in that review process you'll look at low-income housing tax credits, where you've already moved from 400% to 100%. It should be closer to 20%. These are very stable assets.
Gentleman's time has expired.
And my time has expired.
How are you, Chair? Thank you for your service. During your Senate confirmation hearing on April 21st, 2026, you said, quote, "The measures I prefer looking at are things that are called trim averages, where we take out all of the tail risk." Separately, on May 31st, 2026, the Wall Street Journal reported that you want the Federal Reserve to give greater weight to the Dallas Fed's trim mean PCE. And so I want to offer a critique and then have you respond. Trim mean PCE lagged behind core PCE in detecting the inflation shock that began in 2021. Core PCE crossed the Federal Reserve's 2% target in March 2021. Trim mean PCE did not cross that same threshold into July, a 4-month lag. By February 2022, core PCE had risen to 5.4%, while trim mean PCE stood at only 3.6%, a divergence of nearly 2 percentage points. And so here's my question. If trim mean PCE detected the inflation shock later, understated its severity, and diverged from core PCE by nearly 2 percentage points, why should the Fed place greater weight on it when setting monetary policy? And to put a finer point on it, your core criticism of the Fed is that it was behind the curve on inflation. That same criticism can be leveled against your preferred measure on inflation. So why the disconnect?
So none of those are very good measures of underlying inflation. That Wall Street Journal story that you referenced is incorrect, that I have a preferred measure from one of the reserve banks. If I had a preferred measure, I wouldn't have called for a task force to go back to first principles, and the data task force will be looking importantly at inflation measures. My view is that we need new measures to understand the underlying changes in inflation. Am I interested in what's the mean or median price of a good in a big box retailer? You bet I am, and none of these measures capture that. I am super interested in finding new measures to do a better job to help us inform our decisions so that the inflation of the last 5 years don't continue.
Now, you have repeatedly described inflation as a choice. A simple yes or no question. Do you mean a choice by the Federal Reserve?
I mean a choice by the Federal Reserve and fiscal policymakers both, but I'm not trying to push the responsibility onto you. The Congress said that we're in the business of ensuring stable prices, and that's exactly what we're going to do.
So combating inflation is part of the Fed's statutory mandate, and you view inflation as a choice by the Fed. Combating unemployment is also part of the Fed's mandate. Do you view unemployment as a choice by the Fed?
We have no legislative orphans. We can't just take one part of the statute you give us and disown the others. I will just add a touch of complexity. We have more control over the price level ourselves than we do the unemployment rate. We have some say there, but so do all the policies that you and your colleagues put into place.
But obviously, if you aggressively raise interest rates, that could have the effect of causing unemployment. So in that sense, it's a choice, right? There are multiple forces that shape both inflation and unemployment, and the Fed is one among many. Quantitative easing. Do you believe quantitative easing is inherently inflationary? Yes or no, and then?
That question I can answer simply. I don't think it's inherently inflationary, especially if we adopt quantitative easing in the depths of a crisis. It can often provide liquidity to markets that need it.
So from 2008 to 2014, the Federal Reserve's balance sheet grew by a factor of 5, from about $900 billion to about $4.5 trillion. Yet over the same period, average headline PCE inflation was 1.7%, and average core PCE inflation was 1.5%, below the Fed's 2% target. So the notion that quantitative easing may be inflationary fails to explain the non-inflationary effects of a multi-trillion-dollar five-fold expansion of the Fed's balance sheet from 2008 to 2014. Can you explain that for me?
Yes, Congressman, I can. If the balance sheet expansion were our only policy tool, then that is a reasonable conclusion to draw. But we have several policy tools. The dominant one is interest rates. And so we need to think about both of them in the context of monetary policy.
I want to quickly interject. Do you believe changes in the size of the Fed's balance sheet have an effect on inflation comparable to changes in interest rates?
You had me except for comparable. They can substitute for each other. They can complement each other.
But you don't see them as comparable.
But the balance sheet, they have different effects. Okay. The balance sheet tends to work more through asset prices first.
And I want to interject.
Interest rates more through the real economy.
Do you acknowledge that IORB weakens the relationship between the size of the Federal Reserve's balance sheet and inflation?
Not precisely. I don't know if I can answer that fully in one
You
second.
need to answer it in writing, and it'll be very interesting because these were good questions.
I look forward to doing that.
With your opening remarks, you spoke to the issue of artificial intelligence. And as the ranking member on AI and crypto, I was just curious to try to tease some more of your thoughts out on that. You know, not only in the financial services context, but AI in general. I mean, in the past, the Federal Reserve has been able to identify risks of impact to the financial system, but also in a wider context as well. And I wonder if you'd share some of your concerns about that. And I guess I'd like to know, under your leadership, what will be the Fed's approach on AI and how you protect the system from some of the risks that may be attendant to the adoption of AI.
Yeah, thank you, Congressman. We talked about this a bit in your office, and I appreciate the time. This is perhaps the most significant change in our economy in my adult lifetime. I take the new investments in intelligence, in some sense, to be one where we have to recognize it's a huge opportunity, but it also comes with risks and challenges. It is not the job of the central bank to provide or be certain of what the consequences are over the next 12 or 24 months. But we recognize that the United States is likely to be a big winner. The United States is at the forefront of these technologies. Both the human capital and the capital provided from investors are happening here. So the efficient frontier of these technologies are happening in the United States. This is a benefit broadly to our economy. But I don't want to sound overly complacent about it. These technologies also offer threats when they find their way into adversaries' hands. The infrastructure at the Federal Reserve, the infrastructure at our banks, large and small, they must feel new pressure as people are looking to use these technologies to do harm. So these technologies can be used for good and for harm. Over the long term, I think the U.S. is the winner. Over the long term, I think there is a material improvement in productivity, which should have a material improvement ultimately in wages and the strength of the economy. But the long term it can be quite far out, and we've got to monitor things month by month, quarter by quarter as we get there.
Yeah, the thing that troubles me is every time we talk about AI, I hear about this race, and it's us against China, or it's us against South Korea, or countries in the EU. The problem with that thinking is that in this race, and we're seeing the velocity of change is enormous. It's exceeding, obviously, our ability to regulate AI. At the end of the day, I don't see the United States as the winner. I don't see China as the winner. I see artificial superintelligence as the winner. That's where we're rushing along this course, and at the end of the day, we're creating either us, and it doesn't matter whether the creator of artificial superintelligence is a good guy or a bad guy, or a good gal or a bad gal. That superintelligence itself will be the entity that we have to confront, and I just worry about the broader impact of what's going on right now. There's tremendous resources, as you know, being poured into AI. I just hope that the course of regulation does not meet the same fate that the regulation of crypto did, where the crypto industry spent close to $250 million up here on Capitol Hill, and they got the bill they wanted. If that happens with AI, we are in serious existential trouble, not only in this country, but in this world. And I do believe that the Fed, your position, has influence, has the ability to seek out those dangers that others may not identify. And I just ask you to please consider your role and the resources that you have, that maybe you can put a task force together to look at the broader implications of the adoption of AI. They can't even show us, they can't even explain some of the things that they're using right now. The explainability gap is enormous, but I welcome you. I wish you the best. I really do. I wish you the best.
Warsh. I'd like to begin by emphasizing the importance of the independence of the Federal Reserve. Markets rely on our financial system and the dollar as a stable, safe place to put their money. The stability of our financial system is at the center of our global influence. Our adversaries know that if they can break our debt markets, if they can break the dollar, they can remove one of the largest and most significant advantages we have as Americans. The strength of our system, and in turn our ability to stand up against foreign adversaries, that seek to destabilize it is partially a function of having an independent Federal Reserve. If we lose an independent Federal Reserve, we will lose the confidence of people around the world that use the U.S. markets and the U.S. dollar as a safe haven, and that would be devastating for our economy and the economic security alike. Thank you for your work. I want you to know that I strongly support your ability to operate in an independent fashion. And to that end, Mr. Chairman, before I get into the rest of my questions, I wanted to give you an opportunity to speak on the importance of an independent Federal Reserve.
Thank you, Congressman. I'm happy to do it. The Fed will remain independent on my watch. Fed independence is essential to the proper conduct of monetary policy, and I expect and will ensure that monetary policy is independent over the 4 years of my term. And like you, I think it provides extraordinary benefits in everything we do and strengthens the role of the United States and the U.S. dollar in the global economy.
Really appreciate that. Next, let's talk about the Federal Reserve's balance sheet, kind of following on what Mr. Torres was talking about. I've had longstanding concerns with the effects of the long-term effects of the Federal Reserve's balance sheet. In particular, I also worry about the use of quantitative easing in times of economic trouble can take a long time to unwind, leading to a Federal Reserve balance sheet that continues to grow and grow over time. Mr. Chairman, would you mind commenting just broadly on the use of quantitative easing in monetary policy?
I'd be happy to do it, Congressman. In periods of crisis, when markets aren't clearing, I am willing to be quite aggressive in what the Fed does with its balance sheet, the assets that we buy as necessary in unusual and exigent circumstances. But when crises are over, monetary policy, in my view, should be driven almost exclusively by interest rate policy. One of my former colleagues said it best when he said, interest rates get in the cracks. I'll go on to say, interest rates don't favor one class of people versus another. They don't favor those that have financial assets more than folks that are living off their bi-monthly paychecks. So I like interest rates as the dominant ways to make monetary policy, and I'd prefer, all the things being equal, to use balance sheets when the crises are real. However, I've inherited a very large balance sheet with a very complicated set of assets, and I am open-minded to reforms, as are my colleagues, and I'm keen to continue to work with this task force to achieve that.
Real quick, and I'm skipping to the end because this question matters a lot to me. I have a lot of community banks in Nebraska. It's the lifeblood of agriculture. Can you talk about how you see supervision working and respecting the role of a community bank, especially in rural America?
Congressman, as I mentioned to you in your office, I'm a big believer in the diversity of financial institutions. The U.S. economy benefits enormously by not having a half a dozen big institutions at the top do everything for everybody. The ag community, other communities are well served by the banks that are closest to them. Supervision and regulation needs to take that into account. The thousands of banks that we have are an enviable good, and the Fed needs to do what it can to support them.
Let's break down a long House Financial Services hearing on the Federal Reserve's semi-annual report. 7 members took turns questioning Fed Chair Warsh, and it really came down to 2 big questions. The first was about independence. Can the Fed stay above politics? The second was about the economy. Is it managing inflation, interest rates, and new risks the right way? We'll take both in turn. One thing to know going in. Every questioner in these clips came from the same party, and they were pressing a Fed chair appointed under the other one. So this wasn't a left versus right argument in the room. It was members raising concerns and the chair answering them. Our job is to check both against the record. Here's the distinction that organizes everything. There is what the Federal Reserve is actually built to do, and there is the swirl of politics and new markets around it. Keeping those two straight is how you tell a fair criticism from a talking point. And one ground rule. A fact check isn't about which side you root for. It's about checking each claim against the record, the Fed's mandate, the public data, and what the chair actually said under oath. Some points from the members land. Some are stretched. Some of the chair's answers are solid, and some dodge. We'll take them one at a time. One note on scale, because it explains the heat. This was the Fed's semi-annual report to Congress, one of the rare stretches where lawmakers get the chair in the chair for hours at a time. Dozens of members took a turn across the full hearing, and the exchanges we're checking were among the sharpest of the day. A room that big on a subject this large was always going to run hot. Start with the first fight, because it ran under almost every question. Is the Federal Reserve independent, and should it be? Here's the idea in plain terms. The Federal Reserve sets interest rates for the whole country, and it's designed to do that on a long clock, insulated from the next election. The theory is simple. If whoever holds power could order up cheap money before a vote, you get booms on schedule and higher prices for everyone after. Independence is the guardrail against that. It also helps to know this isn't a new tension. For as long as there has been a Fed, presidents of both parties have wanted lower rates and have said so, sometimes loudly and in private. The record is full of it. So a president leaning on the Fed by itself is ordinary history, not a scandal. What matters is whether the Fed actually bends. Here's how that guardrail is actually built. The Fed is run by a board of governors, each appointed to a long term that deliberately stretches across presidencies, alongside 12 regional reserve banks spread around the country. The long staggered terms are the whole point. They're designed to outlast any single administration, so no one president can remake the board overnight. Congressman Gregory Meeks pressed this directly. He tied his questions to political pressure on the chair, to overseas tensions feeding into prices, and to who really controls the plumbing of the payment system. His worry was that a Fed leaned on hard enough stops being a referee and starts being a player. Warsh's answer was consistent. He said the Fed sets policy off the economic data, not off any politician's wish list, and that the payment system runs on standing rules. That's the correct thing for a chair to say. The honest caveat is that words are easy here. The proof is in the rate decisions over the next year, which we can all watch. Congressman Al Green went at a sharper edge of the same theme, speculative bubbles, and a crypto token tied to the president's name. His framing was that everyday investors can get burned chasing a hyped coin while insiders come out ahead, and he wanted to know where the Fed stands. This one needs care, so here's the clean version. What's fair to say is that a named crypto token carries real bubble risk for small buyers. What isn't established, and what a fact check won't assert, is any specific wrongdoing by any official. We stick to what's on the public record. And Warsh's response was narrow but accurate. He noted the Fed neither issues nor supervises that particular token, and that it sets interest rates for the entire economy, not for any single asset. That's true as far as it goes. It also, fairly, leaves the bigger conflict of interest questions to other bodies, which is where they actually sit. Congressman Bill Foster, a scientist by training, took the most technical run at independence. He asked about emergency tools like currency swap lines and central bank lending, and whether they could ever be steered to reward friends and punish rivals during a crisis. Quick explainer on the tool he named. Swap lines are prearranged deals that let the Fed trade dollars with a set list of foreign central banks, so the world doesn't run short of dollars in a panic. The key fact for Foster's question, the list and the rules are written in calm times, before any crisis, not improvised to favor anyone. So on the record, Foster's fear is more theoretical than proven. Warsh said the facilities run on standing agreements, and that's accurate. The legitimate part of Foster's point is that discretion always exists at the edges, and oversight matters. The overreach would be treating a rules-based backstop as if it were a favor bank. Step back and the independence theme nets out like this. The concerns are legitimate to raise and mostly unproven as stated. Pressure on the Fed is real and ordinary. The guardrails held on paper, and the sharpest accusations belong to investigators and ethics bodies, not to a rate-setting hearing. Watch the decisions, not the adjectives. Now the second fight, and the one that touches your wallet most directly, is the Fed actually managing the economy well? Start with the mission, because every economic question flows from it. Congress gives the Fed two jobs at once, called the dual mandate: keep prices stable and keep employment high. The hard part is that these can pull in opposite directions. Raise rates to cool prices, and you risk cooling hiring too. That tension is the whole ballgame. Here's the anchor number everyone was circling. The Fed's official target for inflation is 2% a year. It is not zero, and it is not a vibe. It's a stated goal the Fed is supposed to steer toward over time. Most of the economic arguments in the room were really arguments about how fast to get back to that line, and at what cost. Congressman Richie Torres pressed on the trade-offs directly. He questioned how inflation is measured, how long rates should stay high, and who pays the price when the Fed keeps money tight. His underlying point, the pain of high rates doesn't land evenly, and the people with the least feel it first. This is the honest core of the rate debate, and both readings are real. Keep rates high too long and you can choke off hiring and small business. Cut them too soon and you can let prices climb all over again. There is no clean answer, only a judgment call under uncertainty. Warsh's answer to Torres was that the Fed weighs both sides of the mandate and moves on the data as it comes. That's the textbook response, and it's defensible. The fair critique Torres keeps alive is that saying we weigh both sides can quietly become code for keeping rates high on the people least able to wait it out. The distribution of the pain is a real question. And here's why the rate call reaches your kitchen table. The Fed's benchmark ripples straight out to mortgages, car loans, credit cards, and small business credit. When it holds rates high to fight prices, borrowing gets more expensive for everyone at once. That's the engine behind Torres's point. The cure for inflation arrives as a bill, and not every household can absorb it the same way. Torres also questioned the yardstick itself, and that's fair game. Inflation is measured by tracking a basket of everyday goods and services, and reasonable people argue about what belongs in the basket and how it's weighted. But it cuts both ways. The same measure can understate what one family feels and overstate what another does, so no single number captures every kitchen table. Now the piece that sounds technical but matters, the Fed's balance sheet. Through years of crises, the Fed bought bonds to push money into the economy, a program called quantitative easing, and its holdings swelled into the trillions of dollars. Winding that down slowly is its own quiet policy, running underneath the headline rate. Quit plain English on quantitative easing, or QE. When rates are already near the floor and the economy still needs help, the Fed creates reserves and buys bonds to lower long-term borrowing costs. It can steady a crisis. The lasting fight is over the side effects, whether all that cheap money inflates asset prices and rewards people who already own things. That's exactly the thread the final exchange pulled, on quantitative easing and the balance sheet as they land on smaller lenders in rural America. The worry there is concrete. When the Fed's tools tilt the field, big institutions often adapt faster than the small-town bank down the road. Put a number on who that is. The country still has several thousand community banks, the small local lenders that do a big share of lending to farms, small businesses, and rural towns. They run on the gap between what they pay for deposits and what they earn on loans, and Fed policy moves that gap directly. So the community bank point is one of the more grounded in the whole hearing. It isn't a partisan talking point, it's arithmetic about margins. A fair reading is that Fed decisions made for the whole economy can squeeze small lenders in ways the headline numbers hide. That deserves attention, and it mostly checks out. The economy theme nets out here. Nobody in the room wanted high prices, and nobody wanted mass unemployment. They disagreed on the mix and the timing. On the record, the Fed's framework is standard and defensible, and the sharpest fair critiques are about who carries the cost of the weight. That's a values question as much as an economic one. One more block, because two questions in the room weren't about old-fashioned banking at all. They were about crypto and artificial intelligence. Congressman Brad Sherman, a longtime crypto skeptic, went at stablecoins. He raised the scenario nobody likes to say out loud. If a big stablecoin issuer blew up, would the public end up on the hook for a rescue, the way banks once were? Fast explainer. A stablecoin is a digital token meant to hold a steady value, usually $1, backed by reserves the issuer claims to hold. The market has grown well past $100 billion. The risk Sherman named is old in a new coat. If people doubt the reserves and rush to cash out at once, that's a bank run without the bank rules. Here's the fair split on Sherman's worry. The run risk is real, and the history rhymes with past panics. But the claim that a taxpayer bailout is guaranteed is not established. Recent law has started to require reserves and oversight for these tokens. The honest read is serious risk, not settled outcome. Warsh's answer leaned on that last point, that stablecoins are increasingly being brought under rules, and that the Fed's job is the banking system, not the whole crypto market. Reasonable. The gap Sherman keeps poking at is that rules on paper are only as good as the enforcement behind them, and that enforcement is still young. Then Congressman Stephen Lynch raised the newest risk of all, artificial intelligence. His warning had two parts. 1. AI systems increasingly drive trading and lending decisions at machine speed. 2. The same crypto and tech lobbying muscle could shape the rules before regulators even understand the technology. Put Lynch's warning in context. A large and growing share of trading in modern markets is already automated, executed by algorithms in fractions of a second, and AI is now steering more of those calls. That's the speed he was pointing at. The upside is efficiency and lower costs. The risk is that machines can also stampede together, faster than any regulator can lean in. Here's why that lands. When many firms lean on similar AI models, they can stampede the same way at the same instant, turning a small shock into a fast one. Regulators worldwide have flagged exactly this. Lynch's concern about markets moving faster than the rulebook is well within the mainstream, not a fringe fear. Warsh acknowledged the Fed is studying AI in the financial system, which is accurate and appropriately modest. The unresolved part, and Lynch is right to press it, is that no one has a proven playbook yet for a market where the fastest actors are machines. Naming the gap honestly is better than pretending it's solved. So tally it up. Across both fights, which concerns actually hold up against the record? On independence, pressure on the Fed is real but ordinary. The sharpest conflict claims are unproven and belong to other bodies, and the guardrails held on paper. The members were right to ask and wrong to assume the worst is fact. On the economy and new risks, the community bank squeeze and the AI warning are the most grounded points in the whole hearing. The rate trade-off is a genuine judgment call, and the stablecoin run risk is real even if a bailout isn't guaranteed. None of this tells you how to vote, and it isn't meant to. You can respect the Fed's independence and still want tougher ethics rules around it. You can trust the framework on rates and still think the weight falls on the wrong people. These aren't contradictions. They're the actual choices underneath the shouting. The one mistake to avoid is treating this hearing as a single verdict with one winner. It was really a stack of separate questions, each with its own answer. Some of the members' points were sharp and correct. Some were reaching. Some of the chair's replies were solid, and a few were polished ways of saying, "Not my department." It's also worth saying what the chair got right, because a fair scorecard cuts both ways. On the core mechanics, Warsh's answers were mostly accurate. The Fed's remit really is narrower than some questions implied, and several of the hottest accusations genuinely do belong to other agencies. Credit that even while pressing him on the spots where he was thin. So where does it leave us? With an institution powerful enough to move every mortgage and paycheck in the country being asked fairly to prove it still answers to the data and not to the powerful. That's not an attack on the Fed. That's the job of oversight working as designed. Watch three things from here, and the first is the rate decisions. Whether the Fed moves on the incoming data or whether the timing starts to line up a little too neatly with the political calendar. That pattern over months tells you more than any single hearing answer. Second, watch the small lenders. Whether community banks and rural borrowers keep getting squeezed as the balance sheet winds down, or whether policymakers actually build in a cushion for them. That's the most concrete real-world test that came out of this room. Third, watch the new risks. Whether the rules on stablecoins and on AI in the markets get real enforcement behind them, or stay words on a page while the technology sprints ahead. Sherman and Lynch will have been proven right or wrong on the record, in public, and we'll be here for it. Those answers will come, on the record. The Fed's independence won't be secured by a slogan, and no small-town bank gets protected because a hearing ran hot. The work is in the rate votes, the balance sheet, and the enforcement, and that's where we'll keep watching. That is our breakdown. Stay with us.